Today, the House always wins. The DFA Daily to the 2nd of April 2021. Hello again, it's Martin North from Digital Finance Analytics. Welcome to this post covering finance and property news with a distinctively Australian flavour. Well, no matter how dim a view you take on valuations or the exuberance of retail buyers or even its actual age, the bull market in stocks keeps managing to deliver goods to its faithful, says Bloomberg. Big tech falling? Well, energy and bank stocks pick up the pace. Mem stocks out of vogue? Try software makers that have yet to turn any profits. Discovery Inc. A shares got you down, that's okay. Its B class just inexplicably rallied, the most in 16 years. For every retrograde price action in 2021, there always seems to be an equal and opposite reaction, keeping the market aloft. This week, it was chip stocks such as Applied Materials and electric vehicle makers like Tesla jumping as an overextended reflation trade took a pause. Up a fourth week in 5, the S&P 500 index hit 4,000. That's the milestone it's hit for the first time. Not that the single stock blow-ups have been easy to digest. Look at Viacom's CBS losing half its value a week ago in the Archegos capital debacle. And trying to time peaks remain brutal. Nevertheless, investors are unbowed. They poured $86 billion of fresh money into equity exchange traded funds in March, smashing records for a second straight month, according to data compiled by Bloomberg for the US markets. There is a fear of missing out to a certain extent, said Wayne Wicker, Chief Investment Officer at Vantage Point Investment Advisors. Having that back and forth between growth and value is actually a positive, where it provides broad opportunities for investors. It keeps people more attracted to focusing on equity markets. Technology stocks, laggards in 2021, amid hopes over a return to economic normalcy, sprang up the leaderboard during the holiday-shortened week as France's renewed pandemic lockdown helped revive the stay-at-home trade. The tech-heavy Nasdaq 100 climbed almost 3% for the best gain in 2 months, beating the Dow Jones Industrial Average and the Russell 2000, which added 0.2% and 1.5% respectively. Also contributing to Nasdaq's resilience was Taiwan Semiconductor Manufacturing Co. joining Intel Corp in announcing robust spending plans, and President Joe Biden's infrastructure proposal unveiled on Wednesday, which included a major push to accelerate the adoption of battery-powered cars. You can credit massive monetary and fiscal support for the equity buoyancy, though a nagging feeling among doubters is that all the stimulus could lead to a very painful retracing. Just as violently as they fell during the pandemic crash, stocks have rebounded, with the S&P 500 jumping 80% since bottoming a year ago. That return already surpasses the total gain achieved in 3 of the 13 previous bull runs. In some circles, the speed of the recovery is a sign that the 12-month advance is merely an extension of the bull market that started in 2009. Others view the pandemic recession as the start of a new cycle in their thinking. Despite sky-high valuations, yields perking up, and day traders heading outdoors, a reasonable rebuttal is that bull markets basically never die this soon. In 13 previous bull cycles in the past century or so, none ended at this point of the cycle. If you consider March 2020 as the cycle start, of course, even the shortest one made it to 2.5 years or so. The average bull market lasted half a decade, with the S&P 500 climbing 10% in the second year. It's psychology, they said. Confidence builds over months and years. The emotional journey from denial to acceptance to euphoria is long. Momentum builds slowly in the economy too. Ultimately, the market follows the economy, and the real economy is like an ocean-going vessel, said Rich Weiss, Chief Investment Officer of Multi-Asset Strategists at American Century Investments. It takes miles for an ocean-going vessel to actually turn around, and the same is true for the economy. Granted, with the COVID-19 pandemic driving monetary policy and the economy into uncharted territory, nothing in the past may be a precedent for now. Still, regardless of the length of the cycle, investors would be better off holding on to stocks, a Bank of America study led by strategists suggested. Her team compared the S&P 500's performance in the 12 months before and after a market peak and found that more than 2/3 of the time, the gains leading up to the terminal high were enough to offset subsequent losses. Just because we've never had a one-year-long bull market doesn't mean we can't have one, said Chris Gaffney, president of World Markets at TIAA Bank. But I would put more faith in the fundamentals, and right now, the fundamentals show that equities are going to continue to go higher. Analysts are ratcheting up their first quarter earnings estimates at the fastest rate since at least 2004. For the full year, the S&P 500 earnings are expected to increase 25% to a record $172.9 a share this year, and rise at a double-digit percentage through to 2023, according to recent analyst estimates. Those estimates may prove conservative, according to Jonathan Gulab, a strategist at Credit Suisse. During the previous two cycles, analysts who had underestimated corporate Americans' earnings power at the initial stage of a recovery had to spend the first few years upgrading their estimates according to their firm's data. Now we have Biden rolling out the infrastructure plan, so there's a tremendous amount of policy stimulus there. And in the pipeline, said Ed Campbell, portfolio manager and managing director at QMA, we're going to see booming growth this year. But on the other hand, applications for US state unemployment insurance unexpectedly rose last week, but still remained near the lowest levels of the pandemic as the labour market meanders along, perhaps towards full recovery. Initial jobless claims in regular state programs increased to 719,000 in the week ended March 27, up 61,000 from the prior week, according to Labour Department data. Economists in a recent survey estimated 625,000 claims. The prior week's figure was revised down to 658,000, which is below the Great Recession's peak. The unexpected increase in claims underscores the choppy nature of the labour market recovery and indicates it will take time to recoup the millions of the jobs lost because of the pandemic. However, vacations are increasing and business restrictions are easing, suggesting employment will accelerate in the coming months. Virginia, Kentucky and Georgia led states with the biggest increases in unadjusted claims from the prior week. The data has been volatile during the pandemic amid backlogs, fraud and new programs. The figures come a day before the monthly employment report, and the median forecast of economists in a Bloomberg survey calls for a 650,000 gain in payrolls in March, the most in 5 months, and some economists are expecting an increase of 1 million. Historical revisions to initial and continuing claims for 2016 to 20 were also released on Thursday. The pandemic peak was revised down to 6.149 million initial jobless claims in regular state programs from 6.867 million. And continuing claims, an approximation of the number of people filing for ongoing state benefit, fell to 3.79 million in the week ended March 20. To some extent, the decline in that figure reflects an improvement in the labour market, but millions of Americans have also exhausted those benefits and moved to federal programs. Continued weeks claimed for the federal pandemic program that extends the duration of unemployment benefits, known as Pandemic Emergency Unemployment Compensation, fell to 5.52 million in the week ended March 13. This program was extended until September in the $1.9 trillion relief package that was passed last month. Applications for pandemic unemployment assistance, which was also recently extended by Congress and provides benefits to those not traditionally eligible, totaled 237,025 last week. And so back to Australia, remembering that the title of this show is that the House always wins. According to the ABC, each weekend across the country, they line up for a quick COVID-restricted viewing. They are shuffled in from the driveway and from the street, subjected to a toned-down version of the usual spin from agents whose main task these days is to act as crowd control marshals and fend off requests for contracts. The competition is intense. Young couples nervously eye each other off, would-be rivals in a quest for their slice of the great Australian dream. Properties listed online on a Thursday are swamped by inquiries, eager buyers and bids. Many are sold within days. In most cases, the auction is Dutch style, conducted in secret with minimal transparency. The final prices routinely come in at well above the indicative range and well above buyers' reserves. It's been a bonanza for the 2/3 of households that own a property, heartache for those desperately trying to get aboard the boom. For anyone involved, the frenzy that has overtaken the real estate has been stunning, if not disturbing, to witness. Few will be surprised then that in March, Australian property prices rose at their fastest pace in 32 years. So far, however, those at the controls have steadfastly refused to budge when it comes to bringing the madness under control. As the head of the banking regulator, the Australian Prudential Regulatory Authority, Wayne Byers, said, it wasn't his job to ensure housing was affordable. His mandate was to protect the integrity of the banking system. Not that those two goals are necessarily mutually exclusive. When prices go crazy, as they are at the moment, history tends to show lax lending standards. Both the APRA boss and Reserve Bank Supremo Phil Lowe insist they are keeping a close eye on lending standards and are prepared to take action if things deteriorate. So far, though, neither are inclined to stem the tide. Unlike previous booms, this is being driven by owner-occupiers and in particular first home buyers. Investors who swamped the property market a few years back until recently have been in decline, but having sniffed the wind and smelt the prospect of easy capital gains, are moving back. Here's a chart showing lending to housing and how it surged by almost 49% in the year to February, and the spectacular jump in first home buyer activity. With interest rates at record lows, 4-year fixed rates are below 1.9%, and government programs at state and federal level aim to encourage new entrants. There is every reason to expect the price action will continue. For many new entrants, home loan repayments are only marginally higher, and in some cases lower, than the rent that they've been paying. On paper, though, this should not be happening. For the first time in a century, our population has declined thanks to a low birth rate and the complete absence of immigration. We've just emerged from the deepest recession in a century and unemployment remains elevated. So demand for property should be in the doldrums, and add to that, the building industry continued almost uninterrupted during the pandemic, boosted by the federal government's Home Builder program. Supply should be lifting. And if you ask any kid who's just emerged from their first high school economics lesson, they'll tell you property prices ought to be plunging. But all that cheap cash swirling through the system has more than made up for the decline in people. And while underlying housing supply is running hot, for some obscure reason, the stock of housing hitting the market has tumbled. According to CoreLogic, the number of houses being listed for sale has plummeted to record lows, plunging 30% below the 5-year average. With the demand-supply dynamics turned on their heads, that weight of money will continue to dominate, continuing to add heat into an already hot market. And when it comes to the economy, the news has been unrelentingly good of late. Unemployment is well below what we anticipated late last year, and our growth has recovered much more quickly than expected. But the situation remains fragile. On the global front, new COVID strains are emerging, vaccine rollouts globally are not occurring as quickly as hoped, and the recovery is, well, at best, patchy. Locally, wages growth is barely registering, business investment is weak, and most of the recovery has been driven by federal government stimulus. From where Philip Lowe sits, it will be years before we can truly say we're out of the woods. That's why he's committed to ultra-cheap interest rates for the next 3 to 4 years. Asset price gains deliver greater wealth and boost confidence, which then feeds into improving spending and sustainable growth. That's why he's been talking down suggestions of a housing price bubble. He'd prefer things settle down naturally. To allow that, the new housing stock and decreased population to work their magic. So far, though, it's not working, which begs the question, how much longer will Dr. Lowe tolerate price gains of the magnitude we've just experienced? And for those in the know, they call macro-prudential controls. Essentially, they are tools that limit the extent to which banks can lend. Instead of a 10% deposit, you may be told you need 20% or even more. Rather than borrowing 6 times your income, you might only be allowed to borrow triple your income. Either or both of these measures would restrict the amount you can borrow and hence how much you could pay. For years, the RBA pooh-poohed them. Interest rate changes, they argued, were the only real weapon when it came to property. 4 years ago, however, the RBA unleashed controls on investors and it worked. Interest-only loans, the preferred vehicle for property investors, weren't exactly outlawed, but they were heavily restricted, forcing many investors out, settling the property market. Now, however, the RBA is facing a bleak choice. The higher housing prices go, the greater the risk we could see a messy unwinding down the track. To stop the boom in its tracks now, or even slow it down, could unsettle confidence and derail the recovery. And once upon a time, it was a central banker's role to rain on the parade, or as William McChesney Martin, head of the US Federal Reserve in 1955, explained, to order the removal of the punch bowl just as the party was really warming up. The idea was to look ahead, to take preventative action and keep things on an even keel. So you got to ask, what's changed now? Well, for a start, there's the fragile state of the global economy. Then there are the concerns of the federal government about to rip away the budgetary support for the jobless and those left vulnerable from the impact of the pandemic on vital industries like tourism. If the government does reduce support, that will put a greater burden on the Reserve Bank to boost growth. And so, with conventional weaponry almost exhausted and no real appetite to push interest rates into negative territory, our economic masters have latched on to a philosophy that's been floating around for quite a while. If housing prices inflate and stock markets keep rising, people will feel wealthier and they will start to spend. That in turn will boost earnings, investment, profits, and lead to higher inflation and wages. In fact, all they've really done is boost asset prices. And now it's hoped soaring asset prices will do the job. Of course, the biggest problem with soaring real estate prices and stock markets is that they drive a mighty wedge between the rich and the poor. Those with assets end up sitting pretty. Those without end up being left further behind. And there's an old saying among investors, markets can remain irrational for far longer than you can stay solvent. So as irrational as the current booms have been, there's every indication that they will go on for far longer than is healthy. Central banks, including our own Reserve Bank, has decided that instead of taking preventative action from removing the punch bowl, they'll let the party go on. It is a dangerous game and one that can backfire. For the negative wealth effect, the impact on spending when financial or property markets tank can damage growth. Ever since the financial crisis, central banks globally have been captured by their own actions. They'll do almost anything to ensure markets remain buoyant, regardless of the longer-term consequences. To be fair, the RBA reckons real estate prices will have to start moderating soon for 2 key reasons. One is that for the past year, we've had no immigration, which should have reduced demand for housing. And second is that a large number of newly constructed properties have yet to come on the market. But if prices continue their stratospheric rise unchecked, it may be forced to look across the ditch for inspiration. The Reserve Bank of New Zealand has just raised the lending hurdles for investors after real estate surged by more than 17% in the past year. So far, though, there's no indication of anything like that here. So as the SMH says, Sydney and Melbourne house prices rose tens of thousands of dollars in just the last month, at least. On paper, the nation's property prices increased at their fastest rate in 30 years over March, with Sydney and Melbourne housing values rising tens of thousands of dollars in 1 month. Property prices nationally increased 2.8% in March, with Sydney up 3.7% over the month and Melbourne jumping 2.4%, according to CoreLogic. Believe, of course, the data to the extent you want to. Over the first 3 months of the year, Sydney's dwelling prices rose 6.7%, with Melbourne up 4.9%. The significant price increases have been particularly substantial for detached housing. Sydney's median house price is now $1,112,671, up about $50,000 since February, with Melbourne house values up $20,000 to $859,097. In the first 3 months of the year, Sydney's detached house prices increased 8.2%. Postscript there, of course, units not at all. In fact, they're going in the other direction, but of course everybody focuses on houses rather than units. ANZ recently predicted property prices could surge by as much as 90% in Sydney and 16% in Melbourne before slowing in 2022. The bank's economists say regulators could intervene to curb lending to stop the market from overheating, though so far APRA has not been at all concerned about lending standards. CoreLogic Research Director Tim Lawless said the last time price surged at this level in Sydney was in June and July 2015. Following this brief surge, the pace of growth rapidly slowed as limits on investor lending kicked in to slow the market. Regional homes have been leading the price boom, leading to speculation the pandemic has prompted a long-term exodus from the capitals in favour of lower density country living. But major cities are now starting to lead the increases. Last month, every capital city grew faster than its regional counterparts, except for Melbourne, which was modestly outpaced by country Victoria. Housing values in regional areas are 11.4% higher over the last year, demonstrating the earlier strong growth trend. Capital city values are now 4.8% higher on an annual basis, with the acceleration in growth evident in March, Lawless said. 40% of first home buyers in Sydney and Hobart were priced out of their property market even before the latest surge in house values, by the way. More expensive houses have also started to outpace cheaper homes in the cities, with the top end of town in Sydney, Melbourne and Brisbane rising faster than lower priced properties. Previously, it was premium value properties that were leading the downturn in these same markets. However, more recently, this trend has reversed as buyers take advantage of improved economic conditions and record low interest rates. However, both ANZ and CoreLogic are suggesting the second half of 2021 will see the rapid price growth slow. While record low interest rates are expected to remain for years, housing affordability issues, a decline in fiscal stimulus and the possibility of tighter lending policies could all have an effect over the next few months. The home builder grant, which tapered down to $15,000 for the first 3 months of the year for new home builders, ended this week. Apartment values in March increased 2.1% in Sydney and 1.7% in Melbourne, with a new median price of $755,360 and $593,121 respectively. Brisbane house prices increased 2.6% over the month, while apartments were up just 1%. But then, as the AFR says, the rapid price growth is causing concern even among industry players. I think the Sydney market is getting too hot too quickly, said Douglas Driscoll, Chief Executive Real Estate Group Star Partners. The rapid rate of growth at the moment is scary. When you see some of the prices that are being achieved at auctions, they are mind-boggling. It makes no sense. Personally, I don't believe this growth is sustainable. Driscoll says the current price boom lacks solid grounding as uncertainties surrounding the pandemic persists. I don't think we're working off a stable base at the moment because we're still in uncertain economic times. We're still in the middle of a pandemic, so the dust hasn't settled yet, he said. When you see a property market that is going gangbusters, you have to look at it and ask what the immediate future looks like. Are people's jobs safe? And can they really service that loan? Robert Mellor, Executive Chairman of BIS Oxford Economics, said Sydney and Melbourne are likely to run out of steam quicker than the smaller capitals. They're likely to run out of puff probably by the end of the year, as these markets have already grown rapidly during the last boom, he said. But the smaller capitals like Brisbane, Perth and Adelaide could continue to see stronger growth because they've been depressed for so long. And experts also worry the current price growth is not supported by the fundamental dynamics of supply and demand. Prices are surging despite zero immigration, suggesting that at some point we'll end up with a chronic oversupply because construction is kept at high levels, said Shane Oliver, AMP Head of Investment Strategy and Chief Economist. Without immigrants coming in, the underlying demand will be running below supply, which will lead to rebalancing. And Louis Christopher, SQM Research Managing Director, agrees that price increases were being driven not by the lack of supply, but by low interest rates. I'm concerned for the fact that the price gains are not based on population growth, so it's not really based on fundamentals, he said. We're not seeing a massive shortage of established properties out there. There may well be a lot more buyers than sellers right now, but in terms of overall supply, it's still relatively healthy in the scheme of things. Most experts expect the property markets will continue to rise in the months ahead, albeit at a slower pace after the expiry of JobKeeper, home builder and rental moratoriums at the end of March. There is definitely a lot of market momentum in the March quarter, which is normal. This is usually a quiet quarter, but there's also a lot of stimulus that's going to be taken off the table all at once, Christopher said. So there is a chance that in the next quarter we may not see such crazy growth. The prospect of APRA intervention later this year is also expected to curb the rampant price growth across capitals. In the absence of an interest rate hike, which doesn't seem to be coming anytime soon, the most likely scenario is that sometime in the next 6 months we'll see APRA starting to tamp down lending, Dr. Oliver said. At the moment, they are saying it's not their job to target house prices, but if growth continues at this pace, they will be forced to act. And finally, New South Wales Fair Trading is to crack down on property underquoting. Well, better late than never, I guess. Dodgy real estate agents have been put on notice, with fair trading inspectors hitting the ground to crack down on property underquoting. Sydney real estate agents were issued with almost $21,500 in fines for breaches of the Property Act last week in the lead up to last Saturday's bumper auction day, with more than 1,200 homes scheduled to go under the hammer. Inspectors identified 47 breaches of the Property Stock and Business Agents Act while inspecting 38 sales agents over the 5-day compliance program, which ended ahead of the Super Saturday of auctions, the Sydney property market's bigger auction day ever. 14 penalty infringement notices totaling $21,450 were issued, 6 of these totaling $12,100, and they were related to underquoting. It is unclear how many agents were fined. Minister for Better Regulation Kevin Anderson announced on Wednesday that teams of inspectors will be focusing on the illegal practice of falsely advertising property or indicating that they could sell for less than the estimated selling price. Buyers have been left increasingly frustrated in Sydney's rising property markets, as advertised price guides are routinely being outpaced by sales prices, with many Sydney buyers automatically now adding at least 20% to a quoted price. Sydney recorded a preliminary clearance rate of 88.3% last Saturday, sidebar. Based on Domain's calculation, we think that's too high, with some homes selling hundreds of thousands of dollars, even millions, above advertised price guides. Notoriously difficult to prove, underquoting occurs when an agent advertises a price guide below their reasonable estimate of the property's likely selling price. By law, New South Wales agents must include an estimated selling price in their agency agreement with the sellers and provide evidence for this figure based on what has sold in the local area in recent times. It can be a single price or a price within a 10% range, but the number should be revised throughout an auction campaign as buyers come through open homes and indicate what they're willing to pay. It is not considered underquoting when a property sells for more than what an agent estimated in the selling agency agreement. Agents who commit an underquoting offence could be fined up to $22,000 and could lose their commission and fees earned from the sale. Before the latest compliance blitz, there had been 22 official complaints of underquoting lodged to New South Wales Fair Trading since the beginning of the year. Just 3 of those had resulted in fines totalling $6,600, along with warnings and trader education, a New South Wales Fair Trading spokesman told Domain this month. A further $6,000 in fines were issued for a range of offences, including underquoting, operating with a licence, and failing to have the right insurance during another compliance blitz in early March, in which inspectors identified 14 breaches while inspecting 33 sales agents. Real Estate Institute of New South Wales Chief Executive Tim McKibben said at the time it was not uncommon for reports of underquoting to increase when the market was hot. But this doesn't necessarily mean that there was an increase in activity. Unfortunately, like every industry, there is a small proportion of practitioners who do the wrong thing, he said. However, the increase in reports of this activity is being driven by the hot market, not by an increase in illegal activity. So that's the odd bad apple defence, which frankly I don't think is correct. Rapidly rising property prices have made it harder for agents to set price guides, with some left genuinely stunned by strong results. Other agents have been unable to update price guides due to tight-lipped buyers, but some are deliberately rejecting offers to avoid lifting a price guide before auctions, industry experts have reported. And Anderson said the last thing potential home buyers needed was to have their time and money wasted by real estate agents providing misleadingly low, incorrect price estimates. Buyers should always ask an agent for their estimated selling price and do their own homework on recent sales in the area, he said. Absolutely right about that. Researching recently sold properties in the area will give you a good idea of what to expect, and if the price is dramatically different for a similar property, question it, he said. We will also be using this opportunity to educate the industry and ensure agents are crystal clear on their obligations under the law. A fair trading spokesman said inspectors had also been attending auctions and open homes on Saturdays, including on the recent Super Saturday, and will continue to do so. Fair Trading conduct various compliance programs targeting a range of matters, including underquoting, and these programs are ongoing at this time due to the market conditions, the spokesperson said. Well, finally, Fair Trade New South Wales has woken up to this widespread practice, which of course we've been talking about on this channel for some time. It is hard to prove, but nevertheless the evidence is there for those who want to see it. And I think the best antidote for it is to do your own research and have a really good feel of where prices are. You can't really rely on the agent to give you crystal clear intelligence at the moment. And so I come back to my starting point. At the moment, in the current environment, the house is likely to win. So a time for caution, a time not to overcommit, and to understand that the risks in the broader economy, and therefore to the housing sector, are rising. And there is certainly a chance that the buoyancy in property prices that we've seen of late could ease later, either because of regulatory intervention or simply because of broader economic conditions changing. So I don't think that this is necessarily a time to rush in and put that FOMO to one side and just be comprehensively logical about buying property at the moment. And by the way, most property investors are still losing money on the rental streams on their property, and if that capital appreciation is only temporary, it's not going to solve their problem. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.